Welcome to Better Returns, where you will learn how to escape the volatility of the stock market by passively investing in real estate like a pro. 90% of millionaires earned and maintain their wealth by investing in real estate. We will share real-life examples from savvy investors so you can do the same. This show is for educational purposes only and should not be considered legal, tax, or investment advice. He drives a 22-year-old Porsche and cries every winter when it goes into storage. Your host and my dad, Matt Hansen.
I'd like to welcome to the show Eric Nelson. Eric has been investing in real estate since 2007. In the last 2 years, he's really focused on large multifamily. He and his team at Wild Oak Capital offer investing opportunities in multifamily apartment syndications. And Eric is the host of the wildly successful Real Estate Mindset podcast. It's a great show. Check it out. I think he's at 87 episodes already now. And he has passion for coaching others and sharing tips for how to be a successful real estate investor. Welcome to the show, Eric. Glad to have you here.
Matt, awesome to be here, man. It's so good to see you again because you were very recently on my show.
Yes.
And it's so cool to like kind of flip flop. And now I get to do all the talking and you have to just ask a few questions. So I love being a guest. So thanks for having me.
Oh, it's great to be here. So what I always like to start with, what's your origin story? How did you discover the power of real estate investing, Eric?
Okay, cool, Matt. I'm gonna talk for a while here because I've actually sort of two stories. But first, okay, so my very first foray into real estate was I was in college with my brother, and we were paying rent to this place, like all college students, right? Like paying rent, living, having fun, whatever. But he was actually just out of the military, so he had a little bit of money, and I was on it was on summer break, so I was like in an internship at this engineering company, and I was actually making pretty good money for a college student, right? And so we were like, man, I bet we could. This 2007 too, by the way, so like anyone could get a loan. So I was like, I bet we could get a loan and buy a house, and we could rent to our friends, and like that's it. Like there's no math, there was no like real thinking behind it. And brother's like, yeah, let's do it. So we got a real estate agent who's super cool, like such a good guy, trusted that we could do it, and found this house, unfinished basement, and bought this house. And, again, we probably had no business doing the loan, right? Like on paper, but they sort of said, okay, well, you make some money and your brother has some cash. Yeah, let's do it. It was 2007, right? So anyway, we did that. We bought it and we slowly finished the basement and we rented it to friends. Like even some of our friends were like, renting the space before it was even finished because it was college and no one cared. And it was like a bed in the corner of this concrete floor and like a beer pong table, like classic college. Learned a ton though, learned a lot. And over time, like, the market kind of hit hard, but we didn't really even care or know because we were in college and our friends were paying us rent. And it was just like kind of that same real estate story. It was like, we just weathered the storm because we had renters, right? So we sold that in 2011-ish, made a little bit of money, not a lot, because the market had been a little rougher. And then sort of fast forward a little bit, my wife and I, so we got married shortly after that, traveled around quite a bit, landed back where I live now. We bought our house, and then we were kind of just like working, like cruising along. And like a lot of people, I was like, I don't want to do this for the next 40 years. Just punch the clock, and like the 401k thing. Cause I kept doing the math. I'm like, how can I put more in my 401k? How can I like get to retirement early? And then somewhere along the way, someone was like, oh man, you can also invest in real estate. And so we bought this rental house with my father-in-law, my mother-in-law, who are awesome people. We partnered up and bought this house together. And again, there was very little math involved, which is unlike me because I have an engineering background, but I was just like, oh, we can cover the mortgage with the rent. Like it'll work. Like that's pretty much my thinking. But then we got into that rental and I was like, a friend of mine then started tipping me off on podcasts, like Rich Dad, Poor Dad, kind of the classics, right? Like Bigger Pockets, that stuff. And I was like, oh, there's a business behind this. And that's when my mind really shifted. I was like, oh, you can actually buy rentals and make a little bit of money. And over time, like build some wealth. And so that's where it kind of clicked in my head. And unfortunately, it took a long time to get there, but eventually I did. So then once we knew that, then we started looking for specific deals. And then we started buying out of town. And then I have a really cool story about a sixplex, but I'll let you jump in if you'd like before I dive into that.
No, that's great. Okay. So what was the gap between, you're in college and you and your brother just decided, hey, we're going to be we're gonna invest in real estate, and you did quite well on that. Between then and when you got married and you started to, okay, I'm going to intentionally go ahead and invest in real estate. Was there a couple of years there? How long was that? The gap?
Yeah. So that was 2000, like 12, 13. So yeah, there was kind of like a 5-year gap. And part of it was just like our stage of life. Like we were traveling around, and we just, I like, my head wasn't in that at all, which I'm glad for. Right. But once we settled down and kind of worked like W-2 9 to 5 jobs, that's when I was like, oh, I don't want to, I don't want to do this forever. And so that's where real estate investing sort of clicked in my head. And so I think some listeners could probably relate to that, right? Like if they're investing passively, or maybe they want to buy a rental house, or maybe they want to be a syndicator, any of those things, all of those work for you to have a different path towards retirement or diversification, or maybe you just want to be a little bit safer investment, perhaps. So that's kind of where I encourage people to step away from the traditional path. 401ks, for better or worse, unfortunately, probably didn't work like they originally designed them. And we just believe in real estate. I think you and I can agree on that. I think it's just a better system.
100%. Because my story is like, yeah, I had all my money in 401k and in the stock market, and I lost 300,000 during 2007 and 8. It took for years and years to recover that. Some of it I did lose. So you're right. And so your motivation was, okay, now I've worked, I've got a W-2 here. I've worked for a while. I'm thinking, do I really want to do that in the rest of my life? That was your motivation to say, okay, we're going to actively go out and invest in real estate. Gotcha. So that was the
100%.
tipping point that says, okay, you know what? And you knew a little bit about it. You had some early success, which is impressive in college doing that. You're an entrepreneur at heart if you did that at that point.
Yeah, I think so. I mean, honestly, like maybe just risk tolerant as well. I'm like, I was always like, what's the worst case scenario? Like we foreclose and we go bankrupt. We don't have any money anyway.
Yeah, they can't take anything from you. You have nothing.
I know exactly. Like, take my stuff. I have nothing. But that wasn't really my thinking. It was more obviously like, I'm a positive person. So like, we can make it work. Like everyone wants to rent a house in college. But yeah, there's some luck and there's some skill. I mean, a little bit of both, obviously. But then once I knew the business model, once I really understood the math behind it, okay, even a single family math isn't terribly difficult. It's like management fee if you're not going to manage it. Repairs, 10%, whatever that might be. Some reserves, 10%, just ballparking here. And then your mortgage. And then that's kind of like, okay, here's your expenses. What's the rent and what's the difference? And that's what you're going to make, more or less, right? Multifamily is a little bit more complicated. We can get into underwriting, but basically, it is a math game. It's basically, okay, is the rent, generally speaking, more than all your expenses? That's a good investment. The other thing is you get the principal pay down. You're going to pay that down over time and someone else is helping you pay for it. Appreciation. Don't want to bank on it, but it's usually there. I mean, there's just a lot of things going on for real estate that we can talk about on and on and on. But yeah, so you're right. My mental shift was basically, I don't really want to do this forever. And so on to kind of my long story, which I'm excited to tell you about. What I would do in that time period was I would walk, my son was just born. So actually this is 2017 now. I have a little bit of knowledge. I have some understanding. We actually took a year off and traveled South America, but that's a whole different story.
Oh, cool.
But yeah, so we were like, okay, let's invest. So I was walking my newly born son all over their neighborhoods. And every time I'd see a for rent sign, I'd call it. And I'd say, hey, beautiful house. I'm not looking to rent. I'm looking to buy. Is there any chance you'd be willing to sell it? And I got lots and lots of no's, right? But I was kind of pushing him along one day and saw this like multi-unit. I couldn't tell how many units it was. And this gentleman out front was like putting a sign in the ground, like a for rent sign. And so I just walked up to him. I was like, hey, I really like your property here. Again, same story. Like, what are you renting for? This one looks vacant. It looks like you have a for rent sign. Would you be interested to sell? And he was like, yeah, maybe. It was like he'd never thought of it, right? Older gentleman, probably 65 or so, maybe a little older. And you could just tell he was almost like worn out. The sign, the for rent sign, was like faded. He'd used that same sign
so many
for like
times.
10 years. Yeah, it was way under rent. So I was like, oh man, this is kind of an opportunity here. So he's like, yeah, I would. But I hadn't really thought about it. I was like, okay, cool. Why don't you talk with your wife? Because we had a little chat. Like we talked about, where he's from and how long do you own it, blah, blah, blah. I said, okay, why don't you talk with your wife? I'll call you in a couple of days. we'll see what you think. So I called him and got to talk. And it turns out it's a sixplex. And he was like, you know what? I'd want $1 million. And you could tell in his mind, he was like, $1 million is astronomical number, right? Like he'd inherited the property. So I don't think he knew what it was worth. And in my market, I live in Colorado.
Oh, okay. Yeah.
Million,
When you said, okay, now I realize, oh, that's a good deal, probably.
Yeah, exactly. So I'm like, $1 million in a lot of markets, that's a terrible deal. But where I live, that's a heck of a deal. So I was like, yeah, actually that might work. And I think I shocked him. He's like, oh, wow. Like, I think he thought, what a sucker. And I was thinking he's a little low, right? But I also wanted to be honest with him. I was like, I actually think that's a fair price. I'm not negotiating whatsoever. I think that actually might work. I need to see the units, right? So then we meet again, go through all the units. It turns out one unit's down. It's stuffed with all of his, unfortunately, his past mother's stuff. Like she had lived in it, passed away, and he just jammed it all in one of these apartments. And you could tell there's some emotions, right? And I was like, okay, look, we definitely would want to buy it, but we don't have a down payment for $1 million property. I know that you inherited this. Would you consider financing it? And he was like, what's that? I was like, okay, well, here's kind of how owner financing works. So I sort of ran him through more or less that process. And I said, okay, again, I know it's a lot to take in. Think on it, talk to your wife, and I'll call you in a couple of days. Same story. Called him back. He's like, yeah, I think we would like to do that. I was like, all right, here's the thing is I think I can get your rent or your payment from me as much as you're making in rents. Because remember, his rents were super low and you do nothing. And then if we default, you get the property back and I'll probably have put some money into it. And he's like, okay, this sounded pretty good. I'm like, but here's the kicker is I don't have a lot of money. So can we put 3% down on $1 million purchase, which is $30,000? He's like, sure. So we got $1 million sixplex for 30 grand down. We had a little bit, obviously put some into it to fix it up. Once we cleared out that down unit, obviously we had immediately a 6th unit to rent. We got it fixed up and rented and it cruised along. And there's actually more to that story, but ultimately the point is if you're creative and you're willing to be like friendly, I think that's the point I like to make of this story is like, it's always about relationships. I could have been greedy and pushed and been like, oh, let's negotiate whatever.
Right.
But he was giving me such a good deal and he's such a cool guy. We still talk to this day. So like, that's kind of the point of that whole story is if you're willing to be hear a bunch of no's, because I heard 100 no's before a yes. 2 is about relationships. That's really what this business is all about.
Exactly. And you solve the problem. And also you're right. This is a really interesting case study because for him to get $1 million, he's going to pay tax on. So he's going to net, 700 or whatever. But we call it in Michigan, a land contract. So basically it was a seller finances that if you default on it, he gets it back, but he's getting these payments more than what he was making probably when he was running it and doing all the work and had all the expenses. He just gets that check from you every single month. I mean, that's a great deal for him too.
Yeah,
he's not just this huge tax bill. He just didn't jump into the highest tax bracket that year.
100%.
So that really was a win-win. That was great that you helped him out too, dramatically, I think.
Yeah. I mean, truthfully, like we helped each other, right? Like you're exactly right. That was the pitch was, hey, you can pay a lot of taxes, or you can defer those taxes, pay some of this down over time. And then, when you're ready for the big check, we can have a balloon payment or whatever works for you. So it was kind of this really cool win-win story. And again, there's much more to the story because it's all about relationships and helping each other and being willing to be honest, and could I have negotiated with him? Maybe got it for 970 or something, maybe, but it's like, was it worth it at the end of the day? No. So that was just a cool story I like to tell about owner financing and just being creative and also just being kind.
Right. Okay. Now, are you willing to disclose so you live in whereabouts in Durango?
Yeah, I live in Durango, Colorado. So Southwest. Yeah. So I actually sold that property recently. If you want to hear the rest of the story.
Will you tell me how much you sold the property? I really want to know because I know it's
so we sold it.
Colorado's the hottest market.
So we bought it for $1 million. We owned it for just over a year because I actually wasn't looking to sell, but I run a meetup in my town, like a local real estate meetup. And so people come and we just talk about real estate, whatever. And there's this guy who was asking, people come to me because I'm the person who's running it. And they're like, hey, do you know anyone who's selling anything? I was like, well, not really right now, but I have a project I'd sell you. And he's like, okay, let me hear about it. But what I decided to do is like, all right, let me talk actually to the lender first and, make sure he's cool with that before I sell to you. So I went to him and I said, hey, would you actually pass on this loan to another buyer that I trust? He's like, oh yeah, that'd be sweet. No problem. So then I told the new buyer, I said, hey, I've got owner financing in place. By the way, it was 4.5% interest rate and a 40 year amortization. So the payments were fairly low, just to make the math work, right? So the new buyer was jazzed. He's like, oh, it's sweet debt. And because I hadn't paid much down, I think we owed probably, $965 or $960 or something like that. Cause the original note was $970, if that makes sense.
Yeah.
So I sold it and I basically brokered the deal where the original financer, the original owner, is still the financer for the new buyer. So it's a win-win-win. I got out of the deal. We made a little money, sold it for 1.15 about a year later. So we made about, after everything we put into it, let's just call it $100,000 maybe in a year's time on that sixplex.
That's incredible.
So
and that's the power of real estate.
Yeah. Yeah. And the thing is, it's crazy. I get a little bit of goosebumps about it. That's a lot of money, right? That's as much money as I made in a year at my W-2. So just kind of side gig, right? And it's totally doable.
So your show is the real estate mindset. So let's talk about, because you've interviewed 80 some people. Let's talk about mindset. I guess really is, why aren't people, first off, if you discover, most people don't know you can passively invest in real estate, because all Wall Street does is keep your money here. That's what they advertise. So they don't know about it. But when people do discover, what are the mindsets that you feel they have to overcome to invest? You've interviewed lots of us like this. So what are the things, the commonality you see that people have to overcome?
So here's what's interesting is a good friend of mine, he's a person that I have drinks with, right? He knows me well. He called me up and he said, hey, I've been seeing that you're doing this other thing, because I'm an engineer by trade. So I still do civil engineering. It's more or less part-time now. About half and half of my time is spent on real estate. Half is still engineering. I'm kind of blessed to be able to kind of dial those up and down. But anyway, so he called me and he said, he knows me as an engineer. He said, I see you're doing this other thing. Is it a Ponzi scheme, or is it he said a pyramid scheme, I think. And I was like, what would make you think it is? What would make you think it's a pyramid scheme? You know me, man. I'm not scamming people out of their money. The biggest investors are my friends and family. So I would say the biggest obstacle is believing that this asset class is as good or better than Wall Street, which I know you love to talk about. First of all, it is, so you kind of have to just more or less trust. And then the second mindset is basically pull the trigger, because, $50,000, let's just say, is a minimum investment in a lot of deals. That's a lot of money. So you kind of have to know, like, and trust is the language we use all the time in the sponsor. So we can talk about sponsorships groups for sure. But I think those two hurdles is one, it's not a Ponzi scheme. Especially if you know and trust the person. And two, you're just going to have to let go of that tight hold on your cash and allow someone else to be the expert. And what's interesting is we have no problem doing that with brokerage firms with our cash in a 401k. It's oh, okay, cool. Yeah, you run it. You're a pro. But if you're a real estate professional, I don't know why, but it just seems harder to trust your money with someone. So those are kind of the hurdles that I see.
Okay. And let's talk a little about how to overcome those. You touched upon vetting the deal and the sponsor. So how do you recommend people vet both of those aspects?
Yeah, I love it. So I think, first of all, if you don't know the sponsor, I think the first thing is, if you know them, you're immediately going to know if you trust and like them. But if you don't know them, one thing that I recommend people do is, if they find me on my podcast or they find me from a friend or whatever, and they're like, hey, how can I be sure about you, kind of thing, and say, well, how about this? Why don't I connect you with some of my investors? And so it's basically references. So you can ask them, hey, can I talk with other investors? So what I do, very obviously, I call those people first and I say, hey, do you mind talking to this new investor and explaining your situation? I'm not just going to toss their number out, right? But if you can ask them to supply references, that's huge, especially if you know the references. Say, hey, my friend invested with you. You just say, oh, cool, go talk to your friend. Ask about their experience with us and how it's been so far. That's one, to overcome it. And then two, what's cool about this, Matt, is like your podcast, right? Like people could come and listen to you talk about this stuff. And I found that to be pretty cool. So if someone's new or they don't really understand some stuff, I'll say, hey, go listen to episode whatever, 68 with Matt Hansen. And we talk about the difference between your retirement account and what's going on here. And it's cool. You just give them an immediate reference. And then, then eventually they can start listening to, oh, you are a professional. Oh, you do know what you're talking about and you know the space. At the end of the day, it's always a risk. You have to say that. But in my opinion, it's a more calculated risk than being in the stock market.
Yes, that's a really good point. You just blindly put your money in with somebody you don't know, and they're motivated. They make money even when the stock market goes down. They still make commissions and fees. When it goes up, they make it. So yeah, it's really interesting. You put it. I never even thought it that way. It's like, yeah, you blindly have millions of dollars in the stock market. Do you know those people? They're not accountable to you. You can't call them if things start going sideways. Say, can you explain to me what's going on with my investment?
Yeah. And that's the thing is like all of my investors have direct communication line with me. Like if any one of them texts me, emails me, calls me, I'm going to answer, right? And explain like, of course, there'll be times that are hard. We've had hard times. We had a couple of tough situations in our investments. For example, we had like a fire in one of our kitchens. And one of those tenants we had to put in a hotel because we were fully occupied. So they had this expense and we're like, you know what, let's get them a gift basket. Let's like treat them like I'd want to be treated in that situation. Right. So we have to tell the investors, say, hey, we had this kitchen fire, cost X amount of money for the property. We took care of it, cleaned them up, took care of the person, onward and upward. And, people like that communication. And there's just times that it's not always as smooth as you want it to be. But the point is, as long as you're honest and clear, every investor should have a direct communication line to your sponsor.
Right. So that's kind of vetting the sponsor, the individual, do your due diligence on them. Like you said, consume their content, find out what type of person they are. I mean, and there's people you just don't vibe with, and that's fine.
Yep, totally.
That's really good. That's why it's important that we're putting stuff out there. And you do a great job of education. First, if your podcast is fabulous, then I know you on your website, you've got articles and stuff, and you've got lots of other information to get them educated on it. But let's talk about the deal. How do you vet a deal? How would you recommend a new investor vet a deal?
Yeah. So we, every group's different. We do a webinar and we try and touch on the main points, right? We're going to touch on your returns, the risks behind it, why we like the property, why we like the market, why we like, all those things. So I would say there's a handful of things as a passive investor you should look at. One is market, right? Like, let's say you're buying in Dallas, Texas. I mean, that's kind of a bad example because Dallas is such a hot market. Let's say like Lubbock, Texas.
There you go. It's better.
Let's like, okay, what do you know about Lubbock? Chances are probably not that much, right? So do a little bit of research on the market. Is there job growth? Is there population growth? Your sponsorship group should explain to you why they like that market. But as a passive investor, take a little bit of time to do some homework. Do you like that market as well? If you don't, stay out of it, right? Like you don't have to invest ever. So market research, 1. 2 would be property research. So then the location of the property itself, like it's kind of hard to know like what's a good, neighborhood within a city, but you can get a pretty good look from Google Earth. You can even call a real estate agent and say, hey, is this neighborhood decent? A little bit of research and you can find out, is this location decent as well? Again, if your sponsor is doing their homework, they should be able to answer that question, but you don't want to trust them blindly, right? And then as far as the underwriting goes, it depends on the person. Some people love to dive deep, but a couple questions I always encourage people to ask. Maybe this is a little bit too in the weeds for this listener base, but what is the cap rate and what is the exit cap rate? Which is meaning, do you expect the market to be worse or better condition than it is now? Right. So we're always assuming the cap rate is going to be worse when we sell, even if it's a high cap rate scenario. We're just going to say, you know what? Chances are, worst case scenario, if our sale date is 5 years from now, we're going to have X number of basis points worse cap rate when we sell a property. And so that's a question I encourage people to ask and try and understand is, are you going to sell at a worse cap rate? Or you're projecting that you're going to, then you're buying. And then you could just start kind of asking a few metrics, right? Like, is it a preferred return? Meaning, do the investors get paid first? Try and understand that a little bit. And then probably the most important thing is, what is the timeline for the investment? So you have to understand your money is illiquid. So that's the one downfall of this is once you put your money in, you have to understand it's in for the life of the deal. And if there's
Mhm.
kind of the bumpy road, maybe the group will want to hold a little longer. So you need to be okay with your money being in there. So those are kind of a handful of metrics I normally tell people to look at and kind of hammer on. Like, what is the exit cap rate for that deal? Are they projecting it to be better? Because that's a pretty dangerous assumption.
Those are excellent tips. Because in essence, you're asking stress test. Along with
Exactly.
that
Yeah.
one, the one we always look at, what is the minimum occupancy to cash flow?
Yeah, I love
And,
that.
is it 60% or is it 85%? If it should be, what would your rule be on that? What's the minimum? I want your number. What
Yeah,
would
I
you
love it.
say is
Well, we're going to
acceptable?
target probably 65, but it depends on the deal, right? Like if it's a really, really nice property, I think you can kind of bring that up a little bit, especially if it has historically high occupancy. If it's a really tough property, like C minus property, we're going to be like 50,
Yeah.
55% because there's just more risk involved with that. And you have the potential to have low occupancy. So it does depend on the market.
Yes.
It depends on the deal a little bit, but we'll just say generally, I liked your number. Let's say 60 as a, as a rule of thumb. What's your number? I guess I'll ask you.
Like our current deal, it's a big deal, but it's in a nice area in Florida. It's 67%. But
Yeah, that's
I
great. If
think
it's a
the
nicer deal,
highest, it's a nicer deal. The highest I've ever went is 72. But I know, yeah, people that were buying in a really tough neighborhood. Yeah, it needs to be below 50 because it's going to take you a while to recover, to renovate the units, fix it all up, maybe bring in security. So you're right, it's dependent. But anything over 70, I don't think I've ever done a deal over 72%
yeah, stress
is the
tests above
break even.
70
So
is
that's a big
getting
tip.
dicey.
Yeah. So
Yeah.
somebody's saying it's 75, 80%. No, that's not good because that could just be a bad year or whatever. And you go down to 80, and now you're cash flowing. So that's a really good tip. I don't think I've ever talked about that. But yeah, I think mid 60s is really good. And it depends on the property. You could go up to maybe 72, 73. But I
Yeah, if
like
it's a
your
really
number.
like A-class property, yeah, I would feel comfortable there. I mean, you're gonna get in hot water with your lender anyway. So there's other things to
Yes.
talk about,
Yeah.
with that. But just generally speaking, what's a stress test? Can you survive 70% for a year, and still be okay? That's the other cool thing we don't talk about all that often is like people ask me what's the worst case scenario. As passive investors, they ask me that a lot. I say, well, worst case scenario is you lose all your money. I have to say that,
Yeah.
right? But what the question I like better is, what's the worst case, most likely scenario? The worst case, most likely scenario is the property doesn't do as well as we thought. We have to sell it maybe same price, maybe a slight loss. Everyone gets their money back, maybe loses a little. That's the most likely worst case scenario. And that would be a really tough situation. I mean, something horribly would have to happen. So that's what's cool about real estate. It's like, it's unlikely. I mean, of course it's possible. It's unlikely that you're going to lose a ton of money. It's more likely you're not going to make as much as they said. So that's kind of fun to talk about as well. Is like, what's the most likely thing? Anyway, so
yeah, that's true. And then we're insured. I always mention that. Is anything Wall Street insured? So if a hurricane hits one of our properties in Florida, it's insured. And not only to recover or rebuild the property, but lost rent. We have lost rent insurance too. Now, okay, I'm
yeah,
going to
no,
ask, did the lost rent kick in? Was the claim too small for just one person to move out? Did you even file a claim? Was it worth
yeah,
it?
we didn't file a claim. I mean, we thought about it. I was like, yeah, it's honestly not worth it. And we talked to our agent, a real estate or
Oh,
a
you did.
insurance agent, and they were like, yeah, probably your premium is going to go up more than it's going to, which I appreciate their honesty. But actually, I do know, and I won't mention any names, but you might know the person too. I know someone who had a big fire in one of their properties recently. It was like last year. And it took out like 10 units. Luckily, no one was hurt. But yeah, insurance covered everything, all the repairs, all the lost rent. Like it was incredible. And they were really stressed, of course. And then talking to them later, they're like, actually, insurance kind of covered the whole shebang plus lost rent. Plus, none of the tenants were even mad. We were able to replace most of them in other newer units. Like it kind of just worked out. And that's a good example of insurance. Like as much as insurance, we might like to kind of tease them and make fun of them or whatever, but it's there for a reason. And so, yeah, you're right. Nothing on Wall Street has that backing.
Yeah. It protects your investors. So in that situation, I'm pretty certain I know what you're talking about. There's been a couple of those, but now you have 10 brand new units that are like beautiful because you have to rebuild them. So that's fascinating.
Yeah.
That's fascinating. Well, now it's time. You've been dropping some great knowledge. Now we're ready for the lightning round.
I love it. Yeah. I didn't know there
Five
was
fun
lightning round. So this,
questions.
this is a lightning round for the lightning round. I didn't even know this was coming, but
Yeah,
I
yeah,
love this
it's
stuff.
exactly. Find fun questions just to learn more about you, Eric.
Okay.
First one, what was your nickname as a child?
I never, well, actually, I had a cool one. So when I was born, my brother was 2, and my name obviously is Eric, but my brother was 2 at the time, barely learning to talk. And my aunt said, "Hey, what's your new brother's name?" Like in the hospital. He goes, Urkit. He couldn't remember Eric. And so my aunt called me Urkit until I was like 30. And I'm, like finally she kind of realized it was getting a little old when she was calling me that in front of my kids. I never really cared, but it was just, so people called me Urkit. My grandpa called me Urkit forever. So that was kind of a funny
That's
nickname.
nice. Urkit. That is pretty good. That's fun.
Yeah.
That is really fun. Okay, number 2. Are you a morning person or a night owl?
Okay, naturally night owl. I like to exercise in the evening, but I've sort of forced myself to be a morning person for the reason, mostly kids. But my kids get up around 6:45, so I always get up at least 45 minutes before them and kind of have a morning routine, I'll call it. I don't really like to exercise in the morning again because it makes me, I don't like it. But I will have like some time alone. I'll do some yoga. I'll do some like intentionality, some gratitudes, like kind of a quick thing to set my mind right before the kids get up. So naturally night owl, but I've sort of forced myself to get up early.
What a good dad you are. What's number 3? What was the first thing you do if you won the lottery?
It depends on how big of the lottery, because there was most recently a $1 billion
Yeah,
lottery winner, which that's kind of a different level. Let's say I want like a normal lottery amount, like $1 million. I would go find a multifamily property and buy it and own it with my wife and I, and just put my money where my mouth is. But if it was big money, I would probably buy a couple houses plus multifamily. That way I could travel around with my family to different parts of the world.
Residence, like, okay, a house.
Yeah.
In,
like, let's say we have a beach house, right?
Yeah,
and then we'd have like, then we have like, and a private plane. As long as I'm dreaming, let's get big. The point is, my wife and I love to travel. And so if I could travel with my family to places that we own, that'd be really cool.
Well, here's the next question. And number 4, if you could live anywhere in the world, where would it be?
I think that's tough. Okay. My mind goes to Barcelona, Spain first, just because I love that city.
Me too.
But realistically, with a family, where we live is pretty hard to beat. Durango, Colorado is pretty sweet because there's desert near, we have skiing. So I would probably, just for a change of pace, I'd probably live on the beach somewhere. So let's say, I don't know, La Jolla, California. I don't know. Something like
That's
that.
my favorite. We lived in San Diego for a while.
Oh, nice.
When we go back and visit, we stay in La Jolla, and I've got friends there.
It's the best.
That is like one. It is just the weather is beautiful year round. It's just such a nice place. So I'm with you there. Okay, number 5. What's one piece of golden nugget advice you give to new investors to help them get better returns? One piece of advice, Eric.
Golden advice. Oh, man, I feel like we're kind of giving away all the secrets today. No, I think be patient. Basically, like let's say you find someone, you learn about syndication, you learn about this process. Be patient. You don't have to put all your money in the first deal. So let's say someone comes to me and they say, I have 150 grand, I want to invest in your next deal. A lot of times what I'll say is, yeah, great. But what I'd encourage you to do is spread that over, let's say 2 deals or 3 deals. So the golden nugget would be, don't put all your eggs in one basket. If you have someone you like, let's say you're Matt's investor, ask him, hey, how many deals do you plan for the next year? Can I be patient and invest in 2 or 3 rather than the first one? So that's usually the advice I give. As much as we like to be able to raise the money quickly and be more secure with the capital, it's the investors come first. So what I normally say is spread your money out over a couple deals, even if it means it's not my deal. Like my investors, I'll say, look, even if we don't have a deal, I'll tell you another good syndicator that I like, yes, and then you can have your money in multiple deals. So the golden nugget would be patient and don't be afraid to spread your money out over a couple deals.
Okay, Eric, where were you 7 years ago? So that was the first 7 years ago when I first get into passive investment. So I had a bunch of money I was putting in, and I didn't do the minimum. So I invested in like 5 deals, and I could have invested in probably 10. Had I done what you said, and that's something I coach people. If you're brand new, just come in for the minimum, get in a couple of deals. Now, if you've been doing it for a while, I've got people that invest in like 12 deals over the years. Do whatever you want to do, and they'll do a couple $100,000. But I love that advice, Eric. And no one told me that when I first started out. When you're new,
that's because most syndicators want to get that raise done, like that's, I mean, I'm not trying to bash on anybody. That's the feeling you get because there is kind of the rushes on, but ultimately what we're after is long-term relationships. And to do that, you got to do right by your investors. So I wish I was in this business 7 years ago, but I'm still fairly new.
It's worked out quite well. Well, thanks so much for your time. Look, first off, you have a program too. I do like my guests to plug whatever they're doing to help other people. So you do have a coaching program. So tell a little bit about that.
Yeah. So I coach people to, if they want to learn the business. Now, I have coached some passive investors. I don't think you need nearly as much coaching. Obviously, we could do a couple sessions and say, here's what I would encourage you to do to figure out, what you need to know to be a really, really educated passive investor. You could also just listen to this podcast. You don't really need coaching necessarily, but what I coach is for people to learn how to purchase multifamily. So that's become the passion of mine, is like, what are the pitfalls? What are things I've learned? A lot of coaches will teach you to go from zero to the deal and then see an ever. But after the deal, there's a lot to learn, right? From asset management all the way through even the loan process, all that stuff. So that's kind of what I focus on. And then, the other thing I'll plug is just my website is Wild Oak Capital. And there's my podcast lives there. And like you said, some educational material. So hopefully people get a little bit out of it.
Good. Thanks so much. And all that stuff will be in the show notes. So you guys can check out Eric's stuff. And that's really important, that you can't do it alone. This is not a individual. Single family homes, you can do it by yourself, but multifamily, you need to have somebody like Eric or somebody that's coaching you along the way, because their mistakes could be $1 million mistakes. So I really think that's great that you're doing that. You're helping people so they don't get in a situation where they lose people's money or do something that could cost them a lot. So I think that's very important. I'm all in for education. Invest in yourself. And that's great that you're offering that, Eric. Well, thanks so much for your time. Oh, go ahead.
I was going to say, it's not your money though anymore, right? So like if you're buying a single family, lose your own money all you want. Yes. But once you're dealing with other people's money, you got to be way more diligent. So thanks for the plug, Matt.
Absolutely. Thanks again for being on the show. I appreciate all the knowledge that you've shared, Eric.
Yeah, thanks. It's been my pleasure.
And that's a wrap. Thank you for listening to Better Returns, brought to you by Hanson Holdings. If you enjoyed this episode, please leave a 5-star review because it helps others discover this valuable content. If you would like to earn truly hands-off passive income, go to hansonholdings.com, where we help you invest in large apartment complexes to grow your family's wealth. See you next week with another awesome episode. Have a great day.